Hi there, John Bowens with Equity Trust Company. In this segment, we're going to talk about the Roth conversion. Now, through this training, I want you to understand how powerful the Roth conversion could potentially be for your retirement. So what is a Roth conversion? Well, essentially what a Roth conversion is it's taking tax-deferred money. So think tax-deductible money, money that you didn't get a tax deduction for, and converting it to a Roth IRA. You could potentially convert a traditional IRA, a SEP IRA, a 401k, or other tax-deferred retirement account. In other words, you're paying taxes on the seed rather than paying taxes on the crop. Now, since Roth IRAs weren't available until 1998, a Roth conversion is a strategy many individuals just really haven't heard much about. Additionally, you'll find that some individuals have been told that they don't qualify for a Roth IRA because they make too much money. So this is where a Roth conversion strategy can be helpful to an investor who's a high-income earner. So what it means is you can take tax-deductible money or tax-deferred money, if you're a high-income earner, and convert it over into a Roth IRA. Some people even refer to this as a backdoor Roth conversion. And we'll talk about what that is and what it means. Now, keep in mind that Equity Trust Company is a passive custodian. We can't give you tax, legal, or financial advice, but we can give you some foundational principles and concepts to help explore this further. We'd encourage that you speak to your own CPA or financial planner in regards to if a conversion makes sense for you or not. But we do have resources for you available here at Equity Trust Company, helpful calculators and some white papers and other guides that you can explore. And ultimately, the purpose of this training is to show you how you could potentially put the pen to the paper or look at a spreadsheet or a calculator to determine if this is right for you. Again, I encourage you to also work with your CPA. Now, let me give you the application in a real-world context. And I met a couple, this was back in February, on a real estate investor cruise. In this couple, they explained to me how back in 2010, they opened traditional IRAs with Equity Trust Company. And they rolled money over from their 401ks, which were tax deductible, into a traditional IRA. And then they subsequently converted each of their traditional IRAs into a Roth IRA. So husband and wife set up traditional IRAs, funded those traditional IRAs with 401k rollovers, subsequently converted those monies to a Roth IRA. At the time of the conversion, it was about $100,000. So they paid taxes on that combined about $100,000, but they were in two separate accounts. They each went out and bought a rental property with each one of their Roth IRAs, started generating cash flow from the rental returns going back into the Roth IRA. They then took those rental returns and they reinvested. They rinsed, repeated, reloaded, and reinvested, as we call it. Those monies went back into the Roth IRA, generating tax-free. Fast forward 10 years later, they now have over $1 million in properties in cash. They have 13 rental properties across their two Roth IRAs, and they are generating $110,000 in tax-free profit, cash flow, on an annual basis. And they're over the qualified retirement age of 59 and a half. So what that means is every year, if they want to, they can take a distribution, and it's all totally tax-free to them. They have tax-free cash flow. Compounding interest in the absence of taxation is an incredibly powerful concept. So rewinding the tape back to 2010, at that time they said, hey, it behooves us to pay taxes on $100,000 instead of paying taxes on over $1 million in properties and cash flow on an annual basis. So now let's get to the whiteboard and let's talk specifically about how you could potentially put the pen to paper or create a spreadsheet to analyze, does it make sense to convert, does it not make sense to convert? And again, you can couple this up with your CPA or tax professional to make sure you're making a prudent decision for your future retirement. Let's get to the whiteboard. So let's put the pen to paper and show you how you could potentially scribe out on your own to convert or not to convert. So going back to the couple that I mentioned at the very beginning of the video, they put the pen to the paper and they said, hey, it makes sense for us to convert when we only have $100,000 instead of over $1 million in properties and cash flow. Okay, so let's jump right into it. Let's say we start with $100,000 and initially here, we're not going to assume that we convert it to a Roth to get the taxes out of the way in the seed. We keep it in the traditional IRA, tax deferred, and eventually when we take the money out, we're going to have to pay taxes. Now, I'm going to apply a 12% return on investment compounding once a year, year over year for 20 years. All right, 100,000, 12%, 20 years, that's going to give us over $1 million in that tax-deferred traditional IRA. Now, it'd be the same if it was a SEP IRA or simple IRA or tax-deferred 401k. All right, those are all like accounts. So over $1 million. Now, let's take a look during our retirement years. Let's say at the age of 60, we decide we're going to start taking $50,000 out every year for 20 years. So $50,000 in year one, and we're going to apply, in this context, we're going to apply a 20% effective tax rate. So 20% on the $50,000 is $10,000 in taxes. Year two, another $10,000 in taxes. Year three, another $10,000 in taxes, so on and so forth. Keep in mind that this $50,000 that we distribute every year from our traditional IRA is added to our 1040 as ordinary income. So that can have potential impacts on all of our other income as well as our Social Security income. Our Social Security income can become taxable. That's the Social Security provisional income tax. All right, so over 10 years, that's $100,000 in taxes paid. Now, if we continue that on over a 20-year stretch, $50,000 every year, and then eventually exhausting the entire traditional IRA, that'd be approximately $200,000 in taxes that we pay in the long run. So now let's rewind the tape and let's go back to 20 years in the past, that $100,000 to convert or not to convert. Let's assume we take this $100,000 and we say, okay, we want to get the taxes out of the way on the stock when it's this big, so we don't have to pay the taxes when it's 16 feet high and 40 rows wide, right? That's the concept here that we're trying to drive home. So we have $100,000 and we're going to convert that entire $100,000, all right, to the Roth IRA. And let's say not just 30%, I'm going to strike that out and I'm going to say 40%, all right? I'm going to say 40% effective tax rate, all in, one of the highest tax brackets, right? So 40% on 100,000, and keep in mind, I'm not talking about income tax brackets, 37%. I'm talking about all in state, federal, effective tax rate, 40%. 40% of 100,000 is how much? That's $40,000 in taxes paid. All right. So you can imagine there's a lot of investors that look at that $40,000 today and they say, that's too much, right? But many folks can be proven that it makes sense to pay the price today so you don't have to pay it in the future. And that's exactly what the couple that I mentioned before did. They said, I want to pay the price today so I don't have to pay it into the future. All right, so now we're going to apply the same compounding interest here, 12% over 20 years. We have our $1 million, all right, let's say at the age of 60, and we're ready to harvest the fruits of our own labor through investing. All right, and we take out, let's say, $50,000 year one, $50,000 year two, $50,000 year three, so on and so forth. How much taxes are we going to have to pay in each year in a Roth IRA? No taxes. No taxes all along the way because the Roth IRA is a tax-free savings vessel. The couple that I mentioned before, $110,000 in tax-free cash flow coming in every single year. The monies that are distributed from that Roth IRA never hit their 1040 as ordinary income taxes. So in a Roth IRA, the taxes are zero. Now, what can we do with that $1 million+ dollars? In the example of the couple, they have $110,000 coming in every year. They're actually not distributing the money for their own personal uses. They're saving that Roth IRA. They're preserving it for their long-term retirement needs, okay? So now we're talking about not just wealth accumulation in the absence of taxation, but we're also talking about wealth preservation. And they can leave that to their children, or in their case, they're leaving it to their grandchildren. And their grandchildren, 0% tax, 0% effective tax rate environment. So now you can see, if we go back here, $40,000 in taxes paid today to save $200,000 in taxes over here, right? So would you rather pay $40,000 short term, or would you rather pay $200,000 long term? Or worse yet, leave that tax bill to your children or grandchildren, because when you leave a traditional IRA to a child or grandchild, ultimately when they start taking distributions, whether they're required minimum distributions or they're taking it out on their own, they're going to pay taxes on that money that they're pulling out of that account. So important to understand that from a legacy planning perspective. Now, obviously, I've made a very compelling argument to pay the price today to not pay it in the future. But it's important that you put the pen to the paper, you use a spreadsheet or a financial calculator, team up with your CPA or accountant, right? So team up with your CPA or accountant to really crunch the numbers here and determine, is this a good fit for me? And it's also contingent on your return on investment. So many equity trust clients, they're investing in alternative assets, real estate. So they're holding rental properties, like the couple I mentioned before. They're flipping real estate. They're making loans secured by real estate. And it's not in all cases, but many investors see the opportunity in alternative investing because they can drive a higher rate of return than what the stock market can yield. So potentially above 12%, above 50%, so on and so forth. Again, there's no guarantees with that. I'm not saying that investing in alternative assets is going to get you 12% return on investment. You need to make that decision in terms of what you feel you can drive in the production of that account. So again, $40,000 or $200,000. That's the picture that we're painting here. So what's so exciting about the story I shared with you earlier about the couple who converted at about $100,000 and now they have over $1 million in properties and cash flow is that all of their distributions, again, are tax-free. So think about it from a cash flow perspective. Creating a totally tax-free, cash-flowing savings vessel. That income generated in that Roth IRA never hits their 1040 as ordinary income. And as an added bonus, if you will, there's no required minimum distributions, RMDs for short. So for those of you that have a traditional IRA or tax-deferred IRA, at 70.5, you have to start taking money out and pay taxes. But in a Roth IRA, you can keep all that money in there without any required minimum distributions. Now, when you leave it to your heirs, whether it's children or grandchildren or other loved ones, they do have to take required minimum distributions, but it's left to them tax-free. So you're creating a tax-free legacy, so to speak. Now, again, very important that you understand some of the tax implications associated with converting money, such as, like we talked about, when you convert money, that amount's added to your ordinary income and you have to pay taxes accordingly. And so we would encourage you to speak to your CPA or tax professional or other financial professional regarding these matters. Now, don't forget to subscribe to our YouTube channel, and we'll see you on the next video. We have a number of YouTube videos and other training to take advantage of, so continue to explore our ongoing education and information.